They said it's about 200 years old. It's called the Cantillon effect. I'm sure some of you guys have been watching my channel for a long time. Have heard me talk about this in the past. So the Cantillon effect basically tells us that whoever's closest to the money supply, whoever gets the money first, has the biggest advantage. So new money doesn't reach everybody at the same time. New money goes out to some people first, and then it trickles through the economy. The early recipients, they buy assets before prices rise. Everyone else gets it later when prices go up. Let's look at this official definition here. The Cantillon effect describes how new money injected into an economy causes uneven price increases, because not everybody gets it at the same time, benefiting those closest to the source first, e.g., check this out, this is deep, e.g. banks, governments, and corporations, before it then does what? So first the money goes to the banks and the people, then it inflates prices for the general public. This is named after an 18th century economist, blah, blah, blah. Early receivers get to spend money before prices rise. So they get the money and get to spend it while prices are still cheap. And by the time everybody else gets the money, prices are expensive. So the first people that get it, their money buys more, but when everyone else gets the money, their money buys less, okay? So check that out. But here's the thing. Which one are you? Which side are you? Well, let's break this down. So, you ever heard the saying, if you can't beat them, join them? How about that? So what we have is whoever gets the money first, and my partner at the Bitcoin Opportunity Fund, James Lavish, put this chart out, the informationist, so I'm stealing it from him, but he talks about how the Fed creates the money, and it goes here to level 1, which is banks, financial institutions. They get the first access to the money, and they buy assets. So they get the money, they buy assets. Then it goes to large corporations, and they invest and start to expand. Then it trickles down to here, and now the asset prices, homes, shopping, utility bills all go up. Asset prices go up first, stocks go up, real estate goes up, asset prices go first. Then level 4, consumer prices go up. So then gas goes up, food goes up, things like that, everyday costs go up. And then the people down here, the bottom, then wages, how much you make, is the last thing to go up. So by the time the little bit of money gets to here, everything else has gone up first. Okay, now while that sounds bad, and it is, this is the flywheel that works. So what I would like to tell you is, instead of looking at things happening to us, maybe we could think about things happening for us. And so if we have rates coming down, money gets cheaper, debt gets cheaper, but assets go higher, and inflation destroys the debt. So if I have a 30-year home, a 30-year real estate property, and my payment is, say, $3,000 a month, today, $3,000 a month is a lot of money. In